think very interesting developments in the last 4-5 months. Lot of uncertainty got created for which nobody had an answer, such as new tariff implementation from US and border tensions between India and Pakistan and other geopolitical developments that happened globally. On the other side, Reserve Bank of India in India continues to focus on getting back on growth. And if you look at an overall basis, while each one of them had its own impact in creating some bit of uncertainty among investing public at large, as well as different impact for different economy, right from US to Europe to China to emerging market. And the tariff-led impact was quite severe for some nations, and nobody had any clue in terms of how it will get settled down. But one good thing that seems to have happened in the last few weeks, and whatever uncertainty got created, the speed at which it got discussed created uncertainty. At the same speed at which it's also getting mellowed down, and we are seeing some bit of soft handling also seems to have emerged. I think the 2 ceasefire announcement is something one would have ever expected such a fast closure of these discussions, and one would have always felt, if you go by the historical standards, this will be a long drawn process and uncertainty. For those uncertainty also now gets addressed very quickly. So if we go by that, my own belief is one need to get prepared for this kind of volatility to set in. At the same time, it's also equally important to stay with conviction on the long-term investing principle. At the end of the day, in this uncertainty, if as individuals, as investors start reacting as to this will impact my portfolio and this will impact my market sentiment, therefore it will be a long-term process. And then if you decide to keep on sit on the fence, I think it could cost us also a lot of opportunity that may get missed out. So therefore my belief is volatility would stay, but the quantum of volatility may get narrowed, and return expectations will have to be toned down. At the end of the day, return expectation will come on the back of earnings of the companies, and that's something one has to just keep in mind. But otherwise, the world uncertain. At the same time, the world is also looking at finding solutions as quickly as the volatility also sets in. So that being the case, we must also be hopeful that whatever comes as an uncertainty may also get settled down very fast. Therefore, we need to stay focused on asset allocations, long-term investing, and so on and so forth. I think broadly, if one looks at Indian economy is in good shape. I would probably say we are in a very sweet spot from multiple angles, starting from fiscal balance is far stronger, currency has been very stable, inflation a lot more under control, budget gave a lot of impetus for consumption, let go to come back in our country, and spending on infrastructure, which they have done in the last 4-5 years, have started yielding results in terms of passenger traffic rising, especially on railways. Air traffic passenger has been going up, spiritual tourism in India has been rising. All means prosperity, all means improvement in prosperity, improvement in income going up for people. Social benefit scheme that has been announced by various state governments, we can criticize it saying it is more election-led theme, but I look at it positively that more money in the hands of people will increase their purchasing power. Therefore, that also should lead to an increasing consumption as we move forward. Therefore, Indian economy is in a sweet spot. The rate cut which I mentioned earlier also would make money available cheap for borrowers, either for building your assets or for building a business. As the cost of financing comes down, because of which the cost of capital, what they call it in the stock market in the for companies setting up, the cost of capital, if it is lowest, then naturally the benefit for the equity investors will also be very large. So that's why I see from an economic point of view, we are in a sweet spot. I think in India, the entire massacre that you have seen in the global uncertainty, I think India continues to remain silent spectator, at the same time do what we think is right for the Indian economy point of view, is becoming stronger. Among all the economies globally, India is one economy is much stronger in multiple areas, including political stability, which in my own belief is would only help the next wave of movement comes in the equity market. India would be one of the larger beneficiary in terms of attracting flows. At the same time, what you have already done and so far, what you call the high resilience that you have seen in the Indian equity market, will probably continue to see in the low interest rate regime. Indian equity market should continue to reflect the positivity of the Indian economy in terms of its own performance. See, sometimes policymakers need to also be very firm in terms of what they want to do. Given the fact they have gone about advancing the rate cut, which otherwise would have come over a period of next 2 quarters or 3 quarters or maybe the rest of the financial year. Now, having advanced, it is also important for them to make the statement that changing the policy from accommodative to neutral. This, in my view, that set the expectations. I think in any policymakers, one of the expectations that marketplace would always have, not an uncertainty, in a clear terms, what is it they want to do. I think RBI has been becoming more and more clear with the new governor. Strategy has been more to be very clear, give high clarity to the market, so they can focus on work, not on expecting what the policy will do for them to do business. I think this narrative got changed. Therefore, my belief is changing it to neutral. It is and then making it in so many words in black and white through the governor statement. This, in my view, is good, so that all of us as a market players, as market participants, can focus on our own business and building the business, rather than going and asking what the regulator should do or support our business to grow, which in my view is the first time ever in the history of RBI policy. This something is coming, my own belief is very good. So it should be welcomed. Of course, post that markets have reacted, in bond market have reacted, where the yields have gone up by about 20-30 basis points. It's also the function of demand supply. When everything becomes clear, market inefficiency gets removed. If everything is not clear, market inefficiency will always give you an opportunity to make money. If there is no inefficiency, the market has to find its own level, which is what my own belief is would have happened. But having said that, I think market will find its own level. In the bond market side, yields will find its own level, depending upon how the demand comes. And if there is too much demand comes, then naturally money will become costly for the lending point of view. But that's the function of demand supply rather than policy-led action. I think mutual fund is one industry has been quite innovative in product offering, and in terms of tax adjusted return in a mutual fund, if one holds it for long term, is far superior, because at the end of the day we must also plan our taxation and take that into account in generating overall return and financial planning. I think mutual funds, especially ABSLAMC mutual fund, offered debt-plus-arbitrage fund. I think any investment that we don't make for over 6 months or 1 year. All the investments are generally held for more than 1 year and 2 years and 3 years. Therefore, for all the conservative investors who does not take volatility risk on equity, or not even aiming for very high return, at the same time they are looking for a stable return, adjusting for tax, a debt-plus-arbitrage fund could be an ideal choice for them to park their money, which has got, of course, all the features. They can withdraw anytime, no issues. But of course, you will get a better return adjusted for tax if you hold it for more than 2 years. But this for the most of the conservative investors, it can be considered. See, SIP anyway will remain the core, and whether it is new investors, existing investors, I always say the existing investors should increase exposure to SIP. If you get more money, add it up. It's called step-up SIP. And somebody start earning, you start SIP for long term. But having said that, SIP is something while keep this as a center of investment as a principle. I think silent savings actually helps you make money in the long term. Therefore, SIP I always call it as a silent saving, and systematic savings, it comes every month. That's why we call it as a subsidy important plan in mutual fund. is SIP as a strategy. So that's something I would always advise, keep this as a permanent part of your investing principle. The balanced advantage fund and the multi-asset allocation fund, sometimes we do have questions, what is the view on the market, whether it is market is peaked, is the valuation is high, is the market is cheap, is the time to invest, and so on. So this often the question comes to all of us. And we as an individual cannot take these decisions by moving asset from one to other, which will also have, one, we need to have the capability, we need to have time, and we need to also take into account the taxation part and so on and so forth. The balanced advantage fund is actually one size fits all. It gives you an opportunity to participate, and the money managers taking into account the market views, the increased exposure to equity, reduced exposure to equity, and so on and so forth. Therefore, balanced advantage fund could be the one, should be part of the center of the investing theme for everyone. Second is the multi-asset allocation fund. Often we have questions, either silver is good or gold is good, the REIT is good, should I invest in equity these kind of asset classes. Unfortunately, mutual funds have invented multi-asset allocation fund, which invest in equity, which invest in fixed income, which invest in gold, which invest in silver, which invest in REIT and InvIT. All the 5 asset classes gets covered under that. Therefore, that could also be another fund can be considered for investing. So therefore, these 2 asset classes could be made as part of the permanent asset class. In somebody, of course, looking at long-term investing in equity, then naturally funds like Birla Sun Life Frontline Equity Fund, which is a large cap oriented fund, and the flexi-cap fund, which invests in across market cap. Again, Birla Sun Life flexi-cap fund could also be considered from a longer term point of view.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.